Morning, 早晨. Happy Friday. So we heard from the reinsurers, the underwriters, the actuaries, the lawyer. It's now time to hear from the fund managers, the investors in this sector. So I'm Sheng. I'm the co-head of APAC for AMA. AMA, we are the world's largest industry group for the alternative sector. Through our 10 offices, we advocate for over 2,000 fund managers in 60 countries. So we help hedge funds, private market funds, and digital asset funds position themselves for success. Let's go around the line and quick round of introductions from our panel. If you could state your name, your role, and your connection to the ILS story. Massimo, let's start with you.
Thank you. Thank you for the invitation. I'm Massimo Figna. I'm the founder and the CEO of Tenax Capital. Tenax Capital was a boutique created 25 years ago for alternative investments. Currently, Tenax is owned by the Fosun Group through Fidelidade, which is the largest insurer in Portugal.
All right, thank you. Dr. Oz.
Yeah, my name is Urs Ramseier. I'm the founding partner of 12 Capital. We recently merged with Securis. Now it's called 12 Securis. We manage roughly 9 billion of assets in US dollar, 100 people in London, Zurich, Bermuda, and Tokyo.
Thank you. Steve?
Yeah, I'm Steve Smith, and I co-founded, along with my cousin, Maybole Family Office, which is actually mostly based in the UK. I actually live in Singapore. I started in the insurance space back in 1981 as a banker and spent most of my time in Bermuda during the rise of excess lines and in 93, 94 with post-Andrew, all the new property cat stuff. We're our portfolio, we're I guess a mid to large size family office, and we have a fairly large, we run a 50-50 asset allocation model, try to public-private, and our private side consists of anywhere between 40 and 50% cat bonds, so at any one time we're probably involved globally in, we probably own a couple hundred cat bonds at any one time. We do everything ourselves. We have our own sort of thing, but since I've moved to Singapore a couple of years ago and been trying to get into this market, I think we're going to probably elect to allocate to people. This market is a little bit different than what we've had to do, and there's some very high quality managers here. So anyway, that's my background.
Thanks, Steve. Tim.
Hi, so I'm local to Hong Kong. I work for a firm called HSZ Group. I believe we're Asia's only ILS manager, ILS specialist. So we manage ILS funds, but we also help and look to help regional insurance groups or reinsurance groups to structure cat bonds as well.
Thank you, Tim. So I think you can see we have global investors, managers from all corners of the world, London, Switzerland, and of course a homegrown Asian champion as well. So I think the first topic we could tackle is investment performance. So AMO has a private credit affiliate called the Alternative Credit Council, and through that we help fund managers and investors navigate a full spectrum of credit strategies. And the way we think about ILS is a bit like private credit for insurers. Investors provide capital, expect yields in return, and help close the protection gap. So in the fund management business, there's a saying, money talks, everything else walks. So I want to set a scene by giving you some statistics about ILS in terms of its investment performance. This is the one takeaway you need to have. If you haven't been investing in ILS, even for your personal trading account, maybe it's time to pay attention. So ILS, as we probably heard from panel one, is a very mature asset class in Europe and the US. It has several decades of track record, so there's a lot of data you can look at. But it is very nascent in Asia. So starting from a very low base, that means there's a lot of headroom to grow and a lot of opportunity. I think we should focus on the potential. So notwithstanding a quite bumpy year in investment in 2024, actually overall, the ILS sector has done really well. So here are some real numbers. If you look at the number one proxy this investment sector will use, it will be the Swiss Re Global Cat Bond Total Return Index. What is really striking is that in the 23-year history of this index, there's only been one down year. That was 2022. It was down about 2.15% when we have Hurricane Ian hit Florida. In 2024, this index was 17.29% positive return. So it is, I should say, extremely impressive set of numbers. So the other index we will look at is the UCITS Cat Bond Fund Index, where in 2024, last year, it delivered 13.62%. So very impressive set of numbers. I now want to turn to our panel. Perhaps we could start with Urs, Dr. Urs. I presented a positive set of numbers. I would want to invite you to take a critical view, against the backdrop, the macroeconomic environment, and just share with us how ILS has fared, as an asset class from your perspective.
Yeah, I mean, as it was mentioned already in the previous panel, one of the main and key advantages of ILS and cat bonds is it's not correlated fundamentally with equities or other sectors in the financial market. So our clients basically use ILS as a diversifier, and typical allocations are, let's say, between 2 and 5%. That's the average we see from our clients. And indeed, what you mentioned, the returns over the last 2 years were really good. So these were record years in cat bonds and also private ILS. What was also discussed in the previous panel is the difference between cat bonds and the private ILS. So cat bonds is the liquid part, about half of the market, 50 billion, and the other 50 billion is the private ILS market. And usually from an investor perspective, and you mentioned private credit, it's illiquid, rather the private ILS versus the liquid part of cat bonds. And our investors basically expect the illiquidity premium by investing in private ILS, because in the range of, let's say, 2%. So for a similar risk, they would like to see 2% higher return for a private investment. And that's why actually the cat bond over the last 5-6 years were the flavor of the day. Most money went into the cat bond market over the last 5 years. But currently we see a better spread in the private market. So private ILS pays slightly better than cat bonds for similar risks. And we see quite some interest coming back into the private ILS space.
Okay, so you spoke about the returns. Whenever we look at investments, we also want to look at the other side of the equation, which is the risk. So I guess a quick follow-up question. Cat bond yields have remained relatively high over the last 5 years, or should we say the last 2 years, just to be a bit more focused, considering the economic backdrop. So the question is, do you feel ILS investors are being adequately compensated for the risk today?
Yeah, I mean, the yield, the return of ILS and cat bonds has two components. It's the risk spread. That's basically the premium the cedent or the sponsor is paying. And then there is the risk-free rate. That's the return from the collateral. So that's 3 months US Treasury. So the whole ILS market is in US dollars. So the 3 months US Treasury, and the total return is then the sum of the two. Now, obviously, what we have these days are higher interest rates in the US. That's one part of the reason why the returns are higher than in the past. And the spreads were at record highs, let's say in 2023, have come down now. So part of the performance in the cat bonds was also spread tightening, so market-to-market movements into all running yield. And going forward, we expect spreads in cat bonds to stabilize around 6%. So what we get as an investor is 6% plus the risk-free, which makes roughly 10% return. And we believe that's a sustainable level of yield going forward.
Okay, thank you, Dr. Oss. I guess we'll move on to maybe look at volatility. So we've got a lot of family offices here, wealth managers, private banking colleagues. I want to invite Massimo to weigh in. So Massimo, on volatility, Dr. Oz took us through the returns profile. Can you speak a bit more about volatility? And here's the question. So panel one spoke quite at length about climate change. So we saw California wildfires, and there seems to be a lot more of that around the world. So the question is a cat bond investment subject to higher volatility?
The key point to understand is that ILS is an event-driven asset class. So when there is an event, the volatility spike, but this occurs very rarely. I would like to show you a couple of slides to try to summarize some of the data. Sometimes simplicity helps to understand a strategy and a way to present an investment opportunity. You can see here three index. One is the Swiss 3 index, has been mentioned before, and one of the key driver of the benchmark of the ILS industry. The second one is the S&P, and the third is the Barclay US High Yield, obviously, is basically interest rate. So we have the ILS, we have the equity market, and we have the interest rate market. And yes, the perception is that climate change has increased natural disaster, and they are becoming more frequent and severe. But this has not translated necessarily into higher volatility for ILS or cat bond market, as you can see in the evolution since the launch of ILS in 2002 in this slide. Why? Because ILS market is still heavily skewed toward high severity events, especially in the US. Think major hurricane and large earthquake. And importantly, earthquake aren't linked to climate change. And hurricanes impacting the US haven't shown an unusual increase in recent years. Smaller or medium-sized events might be up, second peril, but their impact on the ILS space, especially cat bond, is limited. Take the recent California wildfire as an example. Despite being devastating, most of the damage was covered by private insurance and state-backed insurance of last resort. Very little of the risk was actually ceded to ILS or cat bonds. So while the insurance industry as a whole felt the impact, the volatility in ILS market remained muted. And you can see, as I said, in this visual trend of the three indices, what I just described. A best way also to get the sense of the volatility compared with other investment opportunity is a very simple chart which everybody can make themselves through Bloomberg or data provider. And we have compared here the key investment strategies: cat bond, investment grade, commodity, high yield, equities, and hedge fund. Any portfolio is made of these key categories. And you can see, starting from, this is the slide, 2002, so when ILS was launched, the average annual return of a cat bond was 7.3%, fully comparable with commodities, high yield, equity slightly higher, but hedge fund is the same. But where is the difference? Is exactly in this point about the volatility. So the average volatility, a measure of risk, which is always very difficult to measure scientifically in the cat bond, comparing to credit especially, is the lowest, 3.7. And finally, the ratio between these two index or these two metrics, which is called Sharpe ratio. So there is not in the world any other investment which has a better Sharpe ratio of an ILS investment. And this is not an investment strategy, it's an asset class comparison. So I'm comparing equity with interest rate, with commodities, or with hedge funds. And I think this is the very important measure to compare why on a very long term ILS is better than other asset class. I've had one very wealthy investor asking me, Massimo, this is, you are looking 23 years, so it's easy to say maybe this was because the strategy is still very small. So, and then we created the same table over the last 10 years, and the outcome is the same, slightly different number. So the Sharpe ratio still the highest by far. And then we changed even the horizon to 5 years. So we changed, and the outcome is exactly the same. So slightly tweaked. So in the end, whatever horizon period you take, the Sharpe ratio, which is, I mean, not necessarily the best indicator, but it's a very synthetic way to look at the best risk-reward proposition. The ILS basically has the best opportunity, is the best opportunity over 5, 10, or 23 years.
Massimo, thank you very much. What we are trying to share here as a panel is the traditional analysis that an investor will go through. So there are hedge funds, private credit funds, family offices that allocate to ILS. So we look at risk returns, we look at volatility. The analysis will not be complete without asking a very fundamental question as an investor. What about the liquidity of this asset class? Can you exit? Is there a secondary market? I think to address that question, I'd like to ask Tim. So how liquid is this asset class?
Sorry. Yeah, so I think there's two parts of it. I think for the individual cat bonds, it's about 5 billion of traded, that gets traded every year, parts of about 50 billion, so it's about 10%. But I think one thing that's quite important is most of us here, I think for investors that are, should actually be investing in cat bond funds more likely, right, as opposed to just single bonds. And I think all of us here that manage fund strategies have quite liquid opportunities. So for us, it's about weekly. I believe they would be similar, but they are liquid. It's a very funny asset class in the sense that there's only about 40-something managers. It is a very niche asset class. Every broker knows every manager. There's only about 300 bonds. Every manager knows pretty well every one of those bonds. And so I think that familiarity also increases that liquidity of the underlying bonds. But.
Okay. So I think we have a fairly good idea of the asset class. Let's move on to a different topic, which is inflows and how the investor perspective. So just staying with Tim, we spoke about positive returns, low volatility, and the holy grail of investing, which is the returns that are uncorrelated to the broader equity markets. So what's driving the recent inflows into this sector? What are some of the key drivers, Tim?
Yeah, of course, I think in recent years, of course, the return has been very, very attractive. And so we've seen more people, especially in Asia, for us, being more attracted to the asset class. I think also we focus a lot on, the cat bonds are a fixed income asset class, and so I think also we've seen also on the traditional fixed income, the yields are quite a bit lower, and so we've seen the relative attractiveness of cat bonds increasing. And so locally here in Asia, I think the two groups we've seen increased interest into the asset class has been probably family offices, high net worth, but also fixed income asset managers.
Okay, you spoke about family offices, high net worth. Let's go to a real family office, right? Steve, so maybe we can start with a more personal. What is your ILS origin story? How did you get started in this sector before most of us even heard about it?
It actually went back to when I was working as a banker at Morgan Stanley, and we were hired by the World Bank to look at the feasibility of cat bonds. And I can't remember the exact year of that, but it was before they issued their first cat bond. That was my first exposure, and I'd spent the bulk of my time as a transaction banker there, working on ART or alternative risk transfer stuff in Bermuda. That was sort of I was sort of the de facto guy there. And Morgan Stanley's merchant banking funds at the time were also, they had I don't know, it was fund 2 or 3. It was a large 1.2 billion back in the early 90s, and about 90% of that was invested in insurance, and so I was on the banking side, so they were my client, or I was their client, or whatever. So there was a lot of stuff, and we had capitalized a lot of companies, including PartnerRe, Catley, Tempestry. Everybody was moving to Bermuda post-Andrew because there was no capacity left in the market. And so that was the evolution. And then they were blowing through capital in those early days as well, in the early 90s. And so people were looking at alternative deals. So that's how far back. And then I obviously did some other things in my career, but I've been personally investing in ILS since almost the beginning.
So why ILS? What's attractive from your perspective as a family office?
So I think my philosophy and our family office philosophy is, I don't know, we fall somewhere between as an overall investment strategy, there is some wealth preservation discussion, but there's also some wealth creation. So we're not Elon Musk, we're not shooting rockets into the sky, but we also have generations of people that we have to take care of as well along the way. So one of the main things about cat bonds was, despite our experience with it, my cousin who co-manages also has some experience in insurance as a hedge fund manager. He had done some CRI stuff beforehand. I guess our top risk management strategy is to mitigate drawdowns. We do not want to have any drawdowns, whether it be on the equity or the debt side. So it's 100% mitigation. I can honestly, I guess, confess now, we're almost 100% in cash on the equity side when Trump got elected. And so I can say that the current macro environment, the confusion in the macro environment, or whatever you want to call it, is, the cat bonds just keep continuing to do. The other thing is if you hold it longer term, the compound annual growth rate is significant, right? This isn't, we do buy primarily off the Bermuda Exchange, secondary issues, and again, we're now allocated to one fund, or close to allocated to one fund. But we do this all internally because we have people that actually have done this before. But the longer term, the compound annual growth rate is been, what has driven, from an investment thesis perspective. I think we understand the insurance risk, or we think we understand the deal. But it's all about diversification for us, right? We're spread across, we own, how we got into Asia was actually we bought in the secondary market in a private trade, the peak recat black kite bonds from someone that needed some liquidity. So that was just one way, but we also buy new as well. We have relationships with certain brokers. I think that, these guys all have fairly good sized funds. So, I don't know that we get different deal, but anyway, that's the primary thing of why we like the asset class.
Thanks, Steve. I think you'll be highly sought after we get off stage. More investors will like to hear about your personal journey. So thank you for sharing and pulling back a bit the curtain on the operations of the family office. Not every day we get to hear about how you think about the world. Maybe with that, let's bring Massimo and Dr. Oz back, if I may, just very briefly. So we heard from Steve, the family office investor perspective. How has, from the fund manager's perspective, how has your investor base evolved over the years, if I just get a concise observation from each of you? Massimo, maybe we can start with you and then Dr. Oz.
The investor base and the penetration of the Asia investor, I think, will be a very important driver of the ILS in future. The key word is the supply and demand balance. So it's been mentioned also in the previous panel. On the supply side, the ILS cat bond issue cover Asia risk are still extremely low, 5%. And the Asia global GDP represent 50%. So the gap is extraordinary, is huge. Remember, the Asia region is also where natural catastrophe activity is very high in terms of floods, wind, earthquake, tsunami, and most often these events leave people without anything as the level of insurance is close to zero. So developing ILS is certainly another step toward closing the existing protection gap. This conclusion is indeed supported by the effort of the Hong Kong authority to present themselves as a place to lead new issues. But the demand side is extremely important, as we mentioned before. Sheldon mentioned why he's issued a private bond, but I think if the demand side will increase, maybe this conclusion might change. So the ILS role within institutional portfolio will increase. In US, which is where we can compare data, approximately between 3 to 5% of the pension US funds are allocated to ILS. They have also internal team to do this allocation. So it's a very high developed investment strategy. And obviously, it took 23 years to arrive where we are now in the US. And it's going to probably take another 10, 15 years, less than 23, I believe, in Asia to catch up. And the opportunities, in my opinion, extremely large.
Okay.
Because of the 50% GDP versus the 5% current exposure. So the gap is huge.
The gap is huge, potential, onwards and upwards. I think we firmly believe in the potential of the market. Dr. Oss?
Yeah, traditionally what we see in terms of investor base, that most of the investors 5-10 years ago were pension funds or government state funds and so on. And most recently, over the last 5 years, the strongest growth, however, has come from wealth management and family offices. So the banks or directly from family offices. And these investors tend to go into what we call the UCITS fund, so the liquid part of the ILS market with weekly liquidity. And that's where we saw the strongest inflows. And that's also where we think the growth will be here in Asia, basically from wealth management, family offices. And we're very optimistic about the growth from the Asian investor base in this regards.
Massimo, thank you. I think we're in the last lap of our time. I just want to go to Tim and then Steve. So Tim, you are our homegrown Hong Kong-based manager. I want to invite your perspective on what is the outlook for the Asian market. How are you seeing that?
I think for Hong Kong, the most important to develop the sort of the local ecosystem is going to be, hopefully there'll be more local asset managers like ourselves. I think it's quite important because Asia is a very diverse, it's a very fragmented region. And so, if there's, in order to transact, in order to have more deals between the sponsors into the ILS market, it's important that that's done here locally. And we've seen that, like, for example, for our portfolio, we're about 20-25% allocated to Asia risks, which is going to be quite a bit higher than many of our peers. And a lot of that is because we are here. I see a lot of reinsurance brokers in the audience as well. And naturally, if we have capacity to provide, we are going to naturally look locally as well. And I'm sure the reinsurance brokers will be at our doors as well if they know that capacity is here. And so I think my hope is that there will be more asset managers here locally like ourselves. But in order to have that, obviously, then we need to have more local investors as well. And so I think those are the two things that I hope will come about in Asia. And I think once that happens, I know Hong Kong IA has been very supportive, has been trying to develop, and once we have the structures available, then I think those things will naturally evolve and more, and the local sort of ILS ecosystem will develop. And I do hope, there's a lot of big reinsurance companies in Asia. If you look at the top, I think 40, quite a few of them are here in Asia and here in Hong Kong as well. Two of them I know, or I can see in the audience. I hope also in the future that they also will have reinsurance affiliated sort of ILS managers like some of their peers in maybe Bermuda or Europe. They would have it here and be able to offer products as well to the local investor community as well.
Thank you, Tim. I promise you, Tim did not pay me to ask him this question, but we do want to cheer on the homegrown national champions because nothing beats stronger than the heart of someone who's here. As you say, proximity does give you an edge, and geography is destiny. So, a final question for the panel before we maybe go into Q&A because of time. Steve, can you compress your 500-year journey in ILS into maybe in 1 minute, tips and tricks for your fellow family offices, wealth managers who might be thinking of entering this sector? Yeah. Steve?
I think the strongest thing I've learned about talking to other family offices and getting to invest in this asset class, this is just really a fixed income investment, right? It doesn't need to be demystified into like the technical aspects of it's going to yield what it's going to yield. You're probably not going to take much loss, and as a diversified fixed income portfolio, it deserves an allocation into every portfolio, any family office that runs a portfolio, particularly if you're focused on, drawdown risk. And there's other things you can do if you have more quantitative strategies, which we do some of with ILS. But anyway, it's a very reliable product that will continue to keep performing. We believe, it's not going to do as well as we'd be lucky if it does as well as 23 and 24. We all did very well, but I would just encourage people to take a simple look at it and have an allocation to, look at it as part of diversification of their fixed income portfolio or whatever, and avoid the concentration risk and have well diversification and just accept the fact there's going to be losses in a portfolio. But if if you own enough cat bonds in the mix, it's going to have a very, very nominal impact on, you don't need to wake up on the TV and see Hurricane Milton coming and wondering whether you're going to lose your whole portfolio if you're sufficiently diversified across the globe here. And I think with Asia, with both the Singapore in particular, as well as in Hong Kong, with the grant schemes and more issuance and all of that stuff, and the growth in reinsurance here, Asia is a phenomenal market to invest in. At least that's what we think.
On that positive note, I should add that Tim is actually quite modest. If you ask him in private how well the portfolio is doing, actually, maybe we should have been in this portfolio last year, ILS. But I think the central point you made is a very good one, which is if you think of this ILS as the way a credit investors would think. That's why I said at the outset, we at AIMA, ACC, we think of credit as a very broad spectrum, and ILS, as Steve said, certainly has a place in a traditional, broad-based, diversified portfolio. ILS should be in everyone's portfolio. So on that note, could we maybe have time for perhaps one question? I know we are standing in the way of a quick coffee break. Do we have a question from the floor? Wow, there's a lot of questions. Maybe we'll take one, just in the interest of time. Gentleman at the back, please. I think there's a microphone finding its way to you. Thank you.
Thank you. So I was the lucky one to get the quota. From a family office perspective, right? Because the ILS investment philosophy and the proposition is great. It's uncorrelated, and I've been using it for more than 10 years now. But just curious for the panelists, right? When you try to promote this idea to different family office investors, if there's any pushback, right? Can I understand why? And do you mainly get the resistance from the professional level or the principal level? And what is the pain point, or what's the difficulty for them to actually make the first allocation? Thank you.
Thank you for the question. Perhaps we could go to Steve, and then, okay, we'll just go down the line, but quickly, if we can. Yeah, let's start with Steve first. Steve.
I can say for Asian family offices, the biggest pushback is understanding the technical aspects of how ILS works, and because they're generally not familiar with it, but it's more a terminology thing. And if you are willing to spend the time, which I have done many times, to explain the various terminology and sort of translate it into a fixed income, if you're looking at a traditional bond, the light goes on, and it's actually, cat bonds themselves are very simple to understand. They may be difficult to model at times, but it's a very simple asset class to understand. And I think once they understand that, and they have validation that, I personally believe, not that I'm any great shakes, but that this belongs in every fixed income portfolio of every, not retail, but institutionally. I see that's where the pushback comes. I think they get turned off. Just to be blunt, I think they get turned off by the terminology when people start trying to pitch the asset class, and it's really a terminology situation. So if you can translate that into how simple it is to actually understand how a cat bond performs, I thought the prior guest did a very good job of explaining SPVs and how it works. But it's just like I don't want to put it in the same category, but it's very similar to a CLO or any sort of securitization. You're just securitizing insurance risk, and then understanding that you don't want concentration risk, because everyone has heard the horror stories about investing in, I won't say the name, a fund, government fund, that they've lost all their money, or they've lost a significant amount of money. And that's because they had a big concentration risk of their investment in a single asset, whereas diversification, and I think when you explain the benefits of diversification and how much actually new issuance is out there and how you can spread that risk across, I think people become very, very, very interested in the asset class.
Thank you, Steve. Os, and then Massimo.
Yeah, asking about the pushbacks, I think what is important to understand for investors is that ILS, the risk is not normally distributed, it's a tail risk. So basically you have 99 years, you have very good performance, and you have a big drawdown, right, because you have a big hurricane or an earthquake in California. And investors have to get comfortable with that exposure, and you have to be willing to take that tail risk. And the question you have to ask yourself is, how much drawdown can I take, let's say in 1 in 20 years, 1 in 100 years, and then define the allocation and also the portfolio construction from there. But it's a different type of risk than let's say, credit or equity. And that's really important to understand, because we don't want that our investors wake up in the morning and they lost 10% and so ask why you didn't tell me. And that's really, most part of our job is to explain what can happen and what is exactly the exposure you have in the portfolio.
Right.
And
So
I don't mean to jump in real quick, but I will echo yours point. People have to get comfortable with the potential drawdown risk, but if you've got a well-diversified portfolio and you own a lot of different cat bonds across the world that cover various perils, and you don't get caught up in some of the big multi-peril stuff that you have lots of risk of loss, and you're at the higher attachment points, at least that's our theory, that should be a very, very small period. And we actually model out for people I've explained this to, what happens if your largest cat bond triggers and you lose everything. And you'll see a very, very nominal amount on the overall return, assuming that the cat bonds, the rest of your portfolio performs at historical levels.
All right.
A lack of confidence also comes from the lack of comparability in the data available. Let me explain what I mean. Any family office or investment manager, portfolio manager works with Bloomberg. And you can go in Bloomberg and you can see any ratios or data for equity or fixed income. You have everything. And then if you invest in a cat bond, you have almost nothing. So basically, it's very difficult for an investor to make internal analysis of how much risk in terms of expected loss, for instance, compared with the double B, which is available for any instrument. It is because it is an asset strategy which is still very small, and the data availability is still limited and difficult to compare. So I would say this is probably the pushback. But it's also a function of the fact that the majority of people that works in finance, they study at the university banks, they study equities, obviously is a key asset class. If you haven't had actuarial studies at the beginning, it's very, very difficult that you are very familiar with the cat bond. And finally, the last point is probably catastrophic bond is not the best name. It doesn't help. I had a lot of pushback where people, a catastrophic bond, what is it? And you have to start from scratch, explaining the basic, and calling, obviously the name has been changed in insurance-linked securities, but in the end you finish in cat bond. And when you say cat bond, I mean, it's like people are scared just from the name, and then you have to start climbing a mountain explaining that is a very good strategy because the data shows that is a very good strategy, you should invest. But typically when Sharpe ratio, as I said, is very high, is always a great opportunity. Then probably in 10 years, that Sharpe ratio I show will be lower.
Thank you, Massimo. Gloria, Katie, time for one question? All right, now, the boss has spoken. So one question, one final question before we head for coffee. Did we see a hand up earlier? No, just one hand? Okay, gentleman at the front. Thank you very much. The mic is finding its way to you. If I could ask you to keep your question concise and brief to the point, that would be fantastic.
Yes, that's a question to Massimo, back to his asset class comparison. With the return data, for example, for equities on the raw data, we can pretty much assume if you take 1% off, it accounts for the frictional cost of trading and management. How does cat bond compare with other asset classes in terms of this cost issue?
So this data, this table is made with indices, gross of cost, because they are benchmark, they are index. So it's Swiss Re index, is the Barclay index, is the S&P. So the only probably which has already some cost included is the hedge fund, because it's a fund of hedge fund index. So you might say that there is an element of cost involved. But this table is comparable. If your question is, are they comparable? Yes, they are comparable because they are gross of cost, first of all, and they are in dollar. So they are fully comparable from an FX point of view. In terms of cost, then you have to add, if you invest in ETF, obviously the cost is lower than to invest in a fund. So you have the normal cost structure of having your exposure. The only difference in ILS that at the moment, and probably for few years, there is no an ETF. So while in the other asset class, you might invest in ETF, which has typically a lower cost, but that is also represented by the fact that the Sharpe ratio of ILS is high, because the exposure, the size is still limited, and you need expertise to get exposed to, which gives you diversification, proper diversification. But in terms of cost, to answer to your question, you need to add the normal fund cost structure of any other asset class. It's not, the ILS fund cost structure is not materially different than a fixed income fund cost structure.
Thank you, Massimo, and thank you for the question. I think we brought the world to Asia right here in Asia's world city, Hong Kong. I'm going to let Tim, Hong Kong, homegrown champion, take us to the finish. Final pitch, 30 seconds if you like, for ILS, and then we'll go for coffee.
No, thank you guys for coming. It's actually, personally, we've moved here for about 7 years now, and I think now, finally, I think the city is starting to move forward, and I think we do see a lot of investor interest. And so please do look into the asset class. And there's a lot of expertise within this room that you can approach to learn more. But thank you guys.
Well, thank you, Tim, and thank you to the rest of the panel for joining us from really quite a bit of distance with some of you. Thank you for listening patiently, and I think I'll hand it back to our MC.